What is going on, investors? Hopefully you guys are doing well out there. That is right. It is Friday. The weekend is here. And the moment we've all been waiting for is it's time for the FAANG Stock Recap Show here on the Investor Channel, where every Friday we recap all the major news and the technical chart patterns from all the major FAANG stocks. And we had a major downgrade and a major decline in Apple stock this week, down 9%. We've got a lot of news to get to and those technical charts, but we kick things off like we always do with Meta Platforms. This stock started the week closer to $142 per share, down 4.44%, down all fours when your stock is declining, and that is Meta as it ended the week down to $135 per share. This is after Mark Zuckerberg said that the company would freeze hiring. I also believe it was Sheryl Sandberg's last day at Meta as well. Now, Mark's kind of been teasing this a little bit. I think he had an all-hands-on-deck meeting where he said to employees that some of you might decide that you don't even want to be with Meta anymore. It's kind of a passive-aggressive way, I think, of Mark saying maybe some of you guys should leave. I think Mark should grow a pair and just start firing people that might not be performing, but they are freezing hiring and they're starting to focus on kind of the core projects over at Meta. I actually think in the longer term, even kind of the shorter term, maybe the next 12 months, this is going to be the cleansing that Silicon Valley and certainly Meta needed to take after the abundance years that we've had over the past decade. We're seeing Google do this. We're seeing Meta do this. They are starting to pare down on the number of projects. We'll certainly have news stories related to that when we get to Google, but they're starting to pare back and cut cost and become more efficient businesses. That means all of these companies, believe them or not, will probably become way more efficient and even more profitable in the coming years ahead. I'm excited about that. Now, moving on to Apple, started the week at 151. Is this right? I don't remember the last time we've looked at this stock, down 9% in 4 days, end of the week closer to $138 per share. This is after the major headline crossed on the 28th that Apple suppliers fell on the report that Apple is ditching iPhone production boost. And so kind of a tricky headline here. So Apple has kind of their base case for the number of phones that they're going to sell, but they also have kind of a plan where maybe they have to boost production. There's all of a sudden some unexpected demand for the phones. It doesn't appear that Apple is going to see that unexpected demand for maybe the full product line of phones. So they're pumping the brakes in terms of boosting production, but it appears they're maintaining their original estimates here. And I think that's important to understand with Apple. The other important thing to understand is the fact that we constantly get when Apple releases a new phone, there's all kind of analysts trying to make calls. And more often than not, they actually contradict each other. That's why I would wait for Apple's earnings, which come out tentatively on October 27th. We'll get a much fuller picture on iPhone demand. But until then, we'll get a lot of speculation. And Evercore is actually speculating that those iPhone 14 Pro models, as those lead times continue to expand. So if you try to go and order one of these phones, you're expected to wait a good amount of time until you get that phone. It's not an immediate kind of buy and go pick up or immediate buy and have that product shipped. My iPhone 14 Pro was actually shipped directly from China. But the thing we know about the iPhone 14 Pro models is that Apple could sell more of the Pro models and less of the other phones and still have higher margins and certainly higher revenue as well. So the actual physical number of phones, I think, is slightly less important to the actual mix that they sell. If they sell more of these $1,000, $1,100, $1,200 phones, obviously that's going to lead to higher revenues and likely higher profit margins, despite maybe selling slightly less phones than that was anticipated. Now, moving on to this next story is Bank of America made a rare downgrade on Apple. And now look, I have a lot of respect for Bank of America coming out with this call well in advance, I think, of other people that we see analyzing a lot of stocks. They already gave us their fiscal 2023 estimates in terms of revenue. Bank of America is saying Apple's going to come in right at about $379 billion worth of revenue. Wall Street consensus is about $30 billion higher at about $412 billion. Bank of America also assuming that Apple will make over the next 12 months $5.87 per share. Consensus is much higher at about $6.46 per share. Obviously, there's probably some FX impact here as well. The dollar strength shrinking some earnings that Apple is able to achieve in other countries. Bank of America also lowered that price target down to $160 from $185. That still assumes about a $20 price increase on Apple. We'll see what happens there, see if that's a good call from Bank of America. Now, Apple is confirming iPhone 14 production in India as it diversifies away from China. We've reported this over the last couple of weeks that Apple is looking to move in this direction. Apple obviously is very closely married to China, but maybe shifting some of its production over to India, it won't reduce the risk to a large degree because the chips that still go into Apple's iPhones still has some China risk, given that the fact that they're all made in Taiwan, but it does insulate them a little bit from those lockdowns that are happening in China, that if you have those factories locked down, at least you have a little bit of mitigating effects by producing some of those phones in another country. Now, Taiwan Semiconductor, otherwise known as a TSM, asked Apple for 2023 price increases, and Apple said no. And this is a really complicated relationship because TSM relies a lot on Apple in terms of its volume production and likely revenues and profits. And Apple obviously relies almost exclusively on TSM to produce the chips in their phones. Both of these companies really need each other very much. And so it appears they're both playing, or at least Apple in this case, is playing hardball. My guess is they'll have to meet some kind of agreement. This is kind of the opening negotiations, if you will, and we'll see how these materialize. TSM, obviously, I'll have another news story here later on. They're going to see cuts from AMD, NVIDIA, probably Intel. All of their major customers are not going to see the demand that they saw this past year. And so TSM is going to be in a position where they're probably going to want to raise prices, but customers like Apple probably sitting in a very good spot. And here's that news story that I was just referring to. Taiwan Semiconductor rose this week in terms of its stock price, even as major customers may cut back on 2023 orders. I would assume when it comes to Apple, they're probably going to cut back on terms of their PC and their laptop chips that were in very high demand over the last 2 years as people started working from home and upgrading their computer systems. The computer systems that Apple sell are so good that if you upgraded like I did last year, I have no reason to go out and upgrade another one unless I just wanted some kind of small performance boost. I think people that are in the PC market, probably a similar type of situation. And so Taiwan Semiconductor is going to be an interesting spot where demand is going to wane a little bit. And so I don't think they're going to be in a strong negotiating spot, as Apple probably believes that as well. Now, moving on to Amazon, started the week at 115, didn't quite get down to 110. I was hoping this one would get caught up in that, but it was only down about 1.92%, down to about $113 per share. This is after Senator Elizabeth Warren, who is a Democrat from the state of Massachusetts, I believe. She and other Democrats are asking the FTC to block Amazon's planned iRobot deal. Now, Amazon agreed to acquire iRobot for about $1.7 billion in an all-cash deal. That was about $61 per share. iRobot was a public company. Currently, shares of that company are trading about $56.50 or so. So there's a small delta between the $61 price and the $56 price where iRobot trades today. Certainly not as wide as we're looking at Twitter and Elon Musk's deal and some other deals out there. This is a relatively small deal, and Senator Warren, while she has influence obviously in Washington, she has less influence over the FTC. The FTC obviously would probably want to try to block this deal, but I believe if it went to court, likely wouldn't have a lot of standing. We'll see what happens there. Now, Amazon is going to raise its hourly pay through a $1 billion investment. If you're in the customer fulfillment or the transportation sector of the business, you're looking to make up to $19 per hour, maybe even more than that, up from the previous $18 per hour, while the hourly minimum wage at other parts of the business remain right about $15 per hour. Remember, the government was trying to get you to fight for 15? Well, all you had to do is go work for Amazon now for $19 per hour. This certainly will impact Amazon from a financial perspective, and Amazon reports their earnings on October 27th. And so we're basically less than a month away here. This will probably not hit the most recent quarter, but probably will be subsequent quarters that we look at. Now, Amazon unveiled several new products this week, including a new Kindle Scribe, which looked kind of like an interesting product, a new Fire TV, and then also this robot that kind of creepily kind of followed you around their house. Kind of an interesting product, and certainly has its use cases and certainly could be built upon to maybe progress some of Amazon's other things that they have going on when it comes to fulfillment. Now, Amazon also scheduled a early Prime Day. This is actually a new event, and you're seeing a lot of advertising around this, especially when you're on Amazon's website and they're using their types of things. But they're an early access sale on October 11th and 12th as every single retailer, including Amazon, but certainly from the apparel perspective, we did a video yesterday on Nike. They have so much freaking inventory. Everybody is stuck with inventory. So these kind of early sales are going to, I think, be very common. And I think the longer you wait, these sales are going to get better and better and better as time goes on. Moving on to Netflix. This one started the week at $229. Ended up, I mean, Netflix is just showing a ton of strength, up 2.45%, end of the week closer to $235 per share. This is after Netflix gained 5%, really just in one day, as Atlantic upgraded on that ad opportunity. I mean, we've been talking about this for months here on the channel. When this was a rumor, this was going to bolt on revenue right to that top line over at Netflix. It also could impact churn in a positive way, as people may go from paying $15, $16 a month for Netflix, maybe down to this ad-supported network. And instead of just subscribing, binge watching whatever show that they wanted to watch and then canceling, this may allow Netflix to have a little bit more sticky platform. The other thing that we've been keeping an eye on, less news flow out of this, but this is actually pretty big news, is that Netflix is launching its own internal game studio. So this is the first studio that Netflix is going to build from scratch. They've been partnering with other game studios to build games, and Netflix earlier acquired a game studio that was already in existence. So they're probably taking some things that they learned there and they're building their own new game studio from scratch in the country of Finland, I believe. And so very interesting developments. They obviously see some traction with that gaming sector of the business and they're continuing to invest in it. I think that's exciting for Netflix investors. Moving on to NVIDIA, started the week at $125, down just 3.5%. Not that bad, honestly, with NVIDIA. Ended the week closer to $121 per share. This is after chip stocks, including NVIDIA, were mixed as Intel unveiled new data center GPUs and other products. We obviously saw AMD release some new products as well. I think on the CPU side, last week, NVIDIA rolled out a lot of new GPUs, but from all the research that I've been looking at, and it's kind of tough to tell these YouTubers whether or not they're getting paid from Intel or AMD or if they have certain biases, but the general consensus was that NVIDIA's GPUs that they just rolled out are very, very expensive. And some people even theorized that they made them so expensive, so it made you go by the previous generation, which if you've been following the channel and the story over at NVIDIA, they have a lot of inventory. They have a lot of GPUs that they need to move through. And the theory is, and this is really just a theory, is that they made their new series of GPUs so expensive and not that great of a performance boost. I mean, there is a performance boost, but it's not this exponential performance boost, that instead of buying the new series, you actually go and buy the previous series, which NVIDIA has a large inventory of. We'll see how that materializes. I don't know. Most of this stuff is just for clicks on YouTube, but I thought that was kind of interesting theories. Moving on to Google, started the week at $98.98, end of the week closer to $95.65. That was a decline of 3.33% on Google. This is after this company, along with Meta, are starting to shutter and close different segments of the business, including their cloud gaming service, Stadia, I believe. This was pretty well hyped, and it looks like just didn't have the traction. I do give props for Google trying these types of things, but then when they don't get the traction, they shut it down and they start cutting cost and those types of things. Now, Google is setting up its first cloud region in Greece. Now, I heard an analyst today on CNBC say that what he doesn't think is priced into a lot of these cloud stocks is you have skyrocketing energy costs, particularly in Europe, obviously related to a little bit to the war in Russia and Ukraine. And so those energy costs could really, really cut margins in those European regions. Obviously, you have the FX or the currency impacts as well. And so we'll see in the upcoming quarters. Google reports their earnings on October 25th, so less than a month away. We'll see if there's any indication that. Obviously, if you've been following the channel, we'll do a Google preview video of their business units, and you'll still see that Google Cloud doesn't generate operating profits, but obviously has strong revenue growth. Now, Google is likely to unveil a new Pixel smartphone and a new Pixel watch sometime next week. Obviously, these have a little bit of impact on Google's revenue. And if Apple is having trouble selling their phones and maybe their watches as well, I don't anticipate Google having a lot more success or any greater success than Apple does. But these are a piece of the puzzle for Google, and I think they're worth investing in. Moving on to Microsoft, start of the week at $239. $239, down just 2.7%, down to about $232 per share. This week, I bought more Google and I bought more Microsoft, and you'll see this on the technical segment as well. We came very close to Amazon as well. Now, Microsoft filed its planned Activision acquisition with the European antitrust regulator. We should get a decision on this. No coincidence that it comes November 8th, which I think is shortly after elections, at least here in the United States, and maybe even over in Europe. My guess, again, is that this deal goes through, but it'll go through after the elections. Now, Pinterest. This actually was a story last week. I meant to include it, and maybe I did talk about it, but Pinterest paired a quick gain on report that activist Elliott, which is investing in the company and becoming kind of an activist investor inside of Pinterest, is suggesting that the company sell itself. And right now you got about a $15 billion company. Microsoft and PayPal in the past have been rumored to buy the stock when it was much, much higher. I think probably closer to a $40 or $50 billion company. Microsoft certainly, even with the $69 billion that they're paying for Activision and other acquisitions that they made over the past year, could figure out a way to pony up $15 billion for this company. A lot of people may not realize this or just don't remember it because Microsoft's business are so wide. They have a very large advertising business. In fact, I believe it's second or third, quite frankly, to Apple, Meta, Amazon, and then I think Microsoft is right there underneath them. And it's still a very strong business for Microsoft. I think they could roll up Pinterest very nicely. Moving on to Tesla, start of the week at 276, ended the week down over 4% to finish at 265. We've got that big AI day that is airing here on YouTube right around, I think, 5 p.m. Pacific time. I don't think, with kids and stuff and trying to eat dinner, I don't think I'm going to be able to tune in live, but I'm certainly going to watch that either tonight or tomorrow. It's supposed to be heavy on really like technical kind of geeky stuff. And so I don't think a lot of analysts are going to watch it and understand really what's going on, or maybe able to connect the dots. Oftentimes with these special presentations, whether it's a battery day or an AI day, even like a product launch for Tesla, usually it's kind of like a sell the rumor type thing, or sell the news type thing is the better analogy for that. And so it wouldn't surprise me if there's some disappointment after this AI day, but from what I've seen that could potentially come out of here, you could have some amazing products from that robotic space come from Tesla down the road. Now, Tesla is expected to set a record delivery with their Q3 numbers, and I think that's indicative with the stock. If you look at the stock's performance over the last month or over the last 6 months, Tesla's actually performed relatively well, certainly compared to some of the other stocks that we're looking at. And it's because they telegraphed their deliveries. They're pretty well understood since they kind of give monthly announcements. And we kind of know the average selling price and the average margin that they're likely to achieve with these types of things. And so there's less speculation when it comes to Tesla's deliveries versus maybe like Apple's phones. And so I certainly expect very, very strong earnings when Tesla reports, and they're expected to report on 10/19. That's actually just a couple of weeks away. Now, finally, there was a fire at Tesla's Gigafactory in Berlin, and it sparked an activist call to halt production. These activists just never give up on anything. That activist probably not going to get their way, but one thing that probably isn't talked about a lot is obviously, again, you have those skyrocketing energy costs over in Europe and Germany as well, where this factory is located. And my guess, that's going to hurt production and hurt the margins and profitability out of that factory, at least in the shorter term. Now, moving over to the technical segment of the show, it's gotten ugly, but not that bad. With the S&P 500, we are still confirming just lower sets of highs, and we did confirm another set of lower lows today. Now, the obvious area where everybody is looking on the S&P 500 is down here closer to 3,400. There's another area where I see a lot of technical analysis and maybe people making predictions on that, closer to about 3,200. Both of those areas should act as some support for this stock, as the 3,400 area was the peak before you had that big gigantic March bottom, but you also have this area at 3,200, which acted as support numerous times as well. So will the S&P 500 make the break down to that level when everybody on Wall Street is looking at the same numbers? it tends to come up a little bit short. That's why I've been recommending here on the channel, pick a level and maybe buy or at least start to buy a little bit above that. Now, again, if you only have $1,000 for the rest of the year or the next 12 months to put in the market, there's absolutely no way I would put all 1,000 in at this time. And some of the comments that I get is, oh, the market's just going to continue to go lower and going lower and lower. Well, maybe some of you guys are better at predicting where the stock market is going to go. I'm certainly not going to get on here and try to pick an exact level where I say, hey, this is where it's going to bottom out at. That is a very hard game to play. And if you are wrong with that and things turn around and they turn around rapidly, you are going to miss out on probably one of the better rallies. Again, we would actually expect the market to bottom here very soon and probably rally and confirm maybe another lower low. That would still be a 16-17% rip on this one. On the way down to 3,400, you've got another 4% downside. If you come all the way down here to about 3,200 on the S&P 500, you got about 10% downside. So again, your upside to make a new lower low is probably a 15-16%. If you think this will retest the highs that we made back here in August, well, that's a 20% move. And again, on the downside, you should have support at about 4% lower and more support down here at about 9% lower. The risk rewards in this market are starting to turn itself, and that's why we've turned bullish here on the channel. If you are not comfortable with that, if you are close to retirement, if you somehow need this money into the future, by all means, I would be out of the stock market and I would turn it off and I wouldn't pay any attention to it. But if you want to be far, far richer than you are today, a year from now, 2 years, 5 years, 10 years, you need to be paying really close attention to this, because this is when millionaires are made during these tough times. Moving over to Meta, this one we assumed would probably come down here and test the bottom of the channel. So if it does that, it's still got another maybe 4 or 5% on this one, but we'd expect this one to probably reverse at that point. And if you come back up here, really just make this similar formation that we've been making, that would be over a 20% move on this one. And again, it would still be in a downtrend. It would simply just be confirming another lower high if it makes this type of move. So you've got about 4% downside and the upside potential of 20-25% on this one. If that doesn't get you excited, if you don't understand this type of thing, well, honestly, I'd probably pile into ETFs or passive investments, because this is about as obvious of a buying opportunity as I've seen in my 20 years investing in the stock market. Moving over to Apple, this one's done what we thought it would. Okay, there was an area here at 157 that was like, okay, if you're dying to get into Apple, go ahead and do it there. There was another area here at 150, not super excited about that, but we've had this red line marked out down here, which again was the peak that we made back here in September of 2020. It acted as a little bit of resistance here from December 2020 all the way into April of 2021. Once we launched out over that, it did touch it here back in September 21. I'm talking about this red line here that's about 100 and honestly, it's about where the stock is right now, $137. Now, I didn't step in today because obviously this is really steep momentum here that we've got going on with Apple. I don't necessarily anticipate a very quick bounce off of this level, but if it does, you will bounce back up here to the 150 level. And if we do see a bounce here, we will, in my opinion, kind of confirmed another higher low with this one. Okay, while we're still making lower highs with Apple, and that's somewhat concerning, what we're really looking for is some kind of a reversal pattern where we've bottomed out here maybe in June, maybe we bottom somewhere right here, and then we make another move to the upside. I'm going to step in on Apple underneath this 137 price tag, and that is because I'm already overweight Apple. It's my number one holder, and it kind of flip-flops in terms of value with Amazon, depending on how each stock is doing. So I'm not desperate to buy more Apple, and I'm dollar cost averaging up. Okay, I'm not dollar costing average down because I've had the stock for a very long time. I think for more than 10 years now. So I'm not in any rush to really load up here, but south of 135 on this one, I'm excited about this. I view, quote, rock bottom, probably back testing this downward trend line. You also converge here with an area of kind of flimsy support down here about 115. I would be aggressive with Apple down here at 115. Moving on to Amazon. This one we've talked about here on the channel numerous times. So we have this green box laid out down here. This green box have the highs back in August of 18. Also some highs that we made back here in May and July of 2019. Also has some highs kind of right before those March lows. And then once you burst it up over $100 per share on this one, it really ran. So I kind of view $100 as probably a pretty firm and psychological level of support with Amazon. And I've talked about here on the show where I kind of pick that bottom level and then I'll probably start accumulating about 10% higher. So on Amazon, it was 110. Didn't quite get there today. I think the day range, it got down to 112. I had my order in just for the day. It didn't get filled. No big deal. Momentum remains out of this market. You should have an opportunity at 110. Now, again, if I had $1,000 to put into Amazon, I'm not putting all 1,000 in at 110. It's just to get me to start buying it, get me comfortable. If it keeps going down, I'll buy a little bit more down here at 100. If it continues to pierce through that $100 level, you've got a lot of areas here south of $99 per share where I'd like to accumulate this stock. That would probably actually take it under a $1 trillion valuation. And I just think your risk reward over the next 4 to 5 years on this company being able to double its size from 1 trillion or 800 billion all the way up to nearly $2 trillion, I think are extraordinarily high. And so that's the kind of stock I want to be in. I want to be in stocks that I think are going to be able to double their business over the next 4 to 5 years. Social Security is not going to be there, or certainly not going to support my lifestyle. Certainly being self-employed, I'm not going to have a lot of Social Security. So I've got to build my wealth during these times. That's why I am not scared, and I'm very excited these stocks are going to pull back. These are going to fund my lifestyle in 20 years when I decide to call it quits when it comes to working maybe relatively hard. Now, moving on to Netflix, this one still looks beautiful. It is just floating on this line. Again, we've talked about this here on the channel. I'm looking actually for this one to break up over 250, and that could happen on earnings. You've got earnings on this one on 10/18, so October 18th. We're literally just less than 3 weeks away on this one. A really good earnings report should maybe pop you up over 250. Now, if you have some big gap over 250, I'm not going to really chase it there because typically those big pops are followed up with some kind of back test back to support. I would buy it back on the support level. The reason why I'm waiting for it to get over 250 is this is an area of resistance. A really bad report from Netflix, or if the market really turns negative, it should shoot this stock lower, probably closer to $200 per share. I would maybe be interested in Netflix there, but I am interested in this move up over 250 with momentum. There's this gigantic gap here where you could pretty comfortably go from 250, probably at least to 300, but maybe even as high as $330 on this stock. That's $100 higher than where the stock is right now. So that's the way I'm looking to play Netflix. Moving on to NVIDIA, not much has happened with this one. It's broken through an area of support here at about 127. It's kind of hit its head against it, but just not been able to break through it. We're still in a very defined downtrend with this stock. This downtrend that we've been in since November of last year, a lot of stocks kind of find themselves in this situation. It's still locked in this downtrend. I think it stays in this downtrend based on the fundamental analysis that we've been doing with NVIDIA. There is an area down here that it made some lows back in March of 2021, right about 115. Wouldn't blame somebody with a really long-term focus on NVIDIA to step in at that area, but I am looking at probably a much deeper decline with this stock. Just based on the valuation, you still have a $300 billion company, and this is a company that did about $5 billion in revenue. So it's really expensive from an earnings perspective and a price to sales perspective, certainly compared to Meta and Apple and even Amazon these days, and certainly Google and Microsoft, and quite frankly, even Tesla. This stock is still very richly valued. I'd rather focus my money into other segments of the market, but That's just me. Moving on to Google, this one's just kind of inching its way down. Wouldn't surprise me if this one kind of back tests to this black trend line that we're making, kind of lower lows, and you get down to maybe like $90 per share. That's another $5 lower. I've been just buying just small amounts of this one because, again, I would anticipate this stock, like a lot of stocks, eventually kind of running out of sellers and then the buyers emerge. And that would be like a 26% move. If you go from down here to about $90 back up and just simply back test to another series of lower highs on this one, that would take you up about 25% on this one. Those are the type of rallies that we're going to have in this stock market. And these certainly can be rallies where if they materializes, this could be where you take some profits. This could be some areas where you reduce your risk a little bit if you're a little more concerned about the economy 12, 24 months out than I am. I'm not concerned about the economy. I'm not concerned about what the Fed is doing. Yes, there's going to be some pain in the shorter term, but it is not going to be their mandate to bury the United States economy, bury the European economy, bury emerging markets economy. The United States Federal Reserve is not going to do that. They are going to pump the brakes. Yes, they are on every single day talking tough at some kind of conference. Jerome Powell, whenever he gets up in front of a camera, he's going to talk tough because that's what he has to do. But in the background, in the back of his mind, in the private circles, he's worried as heck that he is going to go too far and he is going to pull up short very, very soon. And if you're not anticipating that, you're going to miss out on one of the best rallies probably in your investing career. Moving on to Microsoft, it broke through the area of support that was here at 244, and it's about to touch another area we have here. Back in August of 2020, we made some highs, kind of danced along that kind of 220, we'll just call it maybe 230 mark. I mean, it came so close. In fact, I think I even bought Microsoft today when it was down at about 232. There's another area down here at about 200. So if this one keeps going down, I'm not concerned. Goes down here to 230, or excuse me, goes from 230 down to 200. Folks, if you can't buy a $230 stock and watch it go down to 200, again, I think you should call Edwards Jones or Schwab and just hand them your money and let them handle things. Because if you can't handle that, especially if you're young, like if you're my age or younger and you can't watch a stock go down $30, like what are you doing? Like seriously, because on the other end of this, we should get a pretty large rally in this stock. We should be able, if we go from the area we're at and retest another lower high on this one, that should take you up about 19%. Obviously you have about 10% downside. You're taking this all the way down to the bottom. That's about 10, 12% lower. The risk reward is starting to set up. And again, that's if we just go make another lower high on this one. Now, if we come back up and retest the highs we made back in August, that would be a 25% move. If we retest the highs that we made back in March, that would be a 36% move. If we retest the highs that we made back in November, that would be a 51% increase. Just retesting the highs that we made back in November. You can't have 51% potential upside without risking at least another 12% to the downside. If you can't have that type of risk reward, well, I tell you what, I think you're too passive, or you're in retirement age. If you're in retirement age or you need this money for some reason, well, obviously that risk is probably a little too much for you. But everybody else out there that doesn't need this money for like 10 years, 15 years, 20 years, 30 years, like this is what you wait for as an investor. Now, finally, Tesla setting up a little bit differently. I would say Tesla and Netflix are kind of in a different boat than all of these stocks. Tesla is still making a very well-defined series of lower highs. We're looking for with Tesla when they report their earnings, potentially breaking out above the key area that we're watching with Tesla is we need to break above 316 on this one. That would be from today's price of about 265. You need to about a 20% move on this one. And in fact, I'd probably push it up to about 26%. You would still be making another lower set of highs. It just wouldn't be as steep. You really need to confirm on this one that you get up about 40%, 44% upside on this one. That would really take you very close to the all-time highs. I still think the downside on this one is probably just another set of higher lows on this one, okay? To where you come down maybe another 19% on this one. I would probably start to buy it at about 240. So we're not not very close with Tesla, but it's getting there. I am hoping this AI day kind of confuses investors and maybe Elon Musk says something or does something a little crazy and people sell the stock off into next week. This is probably the last stock out of all of these that I'm actually want to get a lot more of. Okay. Most of these stocks outside of NVIDIA, which I'm completely out of, Netflix, which I'm completely out of, but I'm heavily invested in Apple, Amazon, Google, and Microsoft. The last stock out of that group that I want to be, quote, heavily invested in is actually Tesla. I'm looking for a pullback starting at about 235 on that one. That one would I'd get excited about this one. We are just a couple of weeks away here from earnings, not only for the entire market, but obviously for these stocks as well. We'll obviously bring you a ton of videos on the channel during that time frame, but I'll also be doing earnings previews on all of these individual stocks. Maybe not Netflix, maybe not one other of these stocks, but for the vast majority of them, they have pulled back into buying zones that I think we need to start being aggressive with, and we need to start looking out 12 to 24 months and seeing where these companies are going to be and be excited about the opportunities we're presented with. If you're in retirement, if you are close to retirement, if you somehow need this money for some reason, well, yeah, you should have sold your stocks 3, 4, 5, 6 months ago and been out of this market. In fact, the videos that we're posting here on the channel were basically telling you that. Now it's time for all of us investors that have a long-term view to put on our big boy pants, realize that we might go down another 5, 10, 15, 20%, but in a year or two, we are going to have 50, 60, maybe even higher gains on a lot of these stocks, and we are going to be sitting back, smoking a cigar and partying while everybody else is saying, man, maybe I shouldn't have put my money into a 2-year instrument and earned just 4%. Folks, we will be partying, but we'll probably having to put up with some more losses in the shorter term. But everybody with a long-term focus is going to come out on the other side of this with a lot more money than the people that are curling up and being scared. Hopefully, guys, enjoyed today's video. We'll be back again soon with more. Good luck with your investments.